So EU-only ETFs feel like a patriotic and logical move right now, especially with the US tariff drama. But what if I told you that your choice could cost you thousands over the next few years? So let me break down what you really gain and lose if you ditch US companies from your portfolio and my unfiltered opinion on the whole situation. Hello finance people, I'm Robert, and on this channel I talk about investing and personal finance from a European perspective. Now, looking back few months, the conversation around EU-only ETFs was mainly negative. Most investors thought going EU-only was foolish because S&P 500 and world ETFs have historically performed much better. One comment I got on one of my videos where I was asking if we should just go all this heavily on US, basically the comment was something like, why would you give up on the winning horse? So why would you move away from S&P 500 and start investing into world or Euro-only ETFs? But now the sentiment has changed quite a lot. So first, let's talk about the benefits of going the EU-only route. First of all, European stocks are still trading at much lower valuations compared to the US. For example, if you compare the PE ratio, so price to earnings ratio, S&P 500 against Stocks Europe 600. Stocks Europe 600 just has the biggest companies, 600 biggest companies in Europe in one ETF. So it's quite similar to S&P 500, but that one is in the US. So S&P 500 has about 28 PE ratio and Stocks 600 is around 17. So the US stocks are currently much more expensive relative to their earnings than the European stocks. So you might be able to find better deals in Europe just looking at this number. The second benefit is that if you're living in the EU, EU-only ETFs protect you from dollar to euro currency. So if there's any fluctuation, that's not going to affect you. And that's especially important if you think dollar might weaken in the future, or like it is right now, it's weakening quite a lot. That might impact your portfolio also. The third pro is that right now, European companies pay usually higher dividends than the US companies. You can see this even in the S&P 500. That one has about 1.3% in dividends, whereas Stocks 600 has 2.7 dividend yields. And obviously another benefit, if the stock prices of European companies increase, that has indirect benefits to the company, like easier funding, cheaper debt. Maybe it's even easier to attract employees to work for that, so the talent acquisition as well. But by investing in EU, you don't actually directly support the European business because keep in mind that you buy an ETF shares on the stock exchange, your money goes to the seller of that share, not directly to the ETF provider or the companies held by ETF. So the seller could be another investor or a fund or a market maker, and they can be located anywhere in the world. So there's no guarantee you will go back to Europe. So your money might go back to US actually. Next, let's take a look at the disadvantages or cons of investing in EU-only ETFs. The biggest disadvantage is that European ETFs have historically just underperformed when compared to S&P 500 or even world ETFs. Okay, that said, big part of that is because of the US tech boom, something that might not keep happening in the future, but for now we are behind in Europe. Let me show you in a graph and it comes super clear what I mean. So let's compare S&P 500 with Stocks 600. Here we have this timeline is from 92 February, and then we have the currency euro. And if we put 10,000 into both of the stocks, how much money we would have now? Well, if we look here for stocks, we would have 121,000, whereas with S&P 500, we'd have 286,000. So more than double the amount. And not only that, S&P 500 is just having really bad first quarter. So if we look even a bit earlier than this, in January, it was 338. So this is big difference when it comes to returns. And if you scroll down here, you can see more. You see that for S&P 500 on average, it's about 10% or 10.6, and for stocks, it's 7.8. The deviation, how much it fluctuates, it's about the same for both, whereas the Sharps ratio that we already mentioned, you can see that that one has higher value for S&P 500, which is you getting more money for the risk you're taking. And there's a clear winner in terms of performance, and it's S&P 500. Now, another con of investing in EU only is when you look at the volatility and how much risk you're taking when you're investing in S&P 500 compared to Stoxx 600. So here we have a graph that compares the volatility between stocks and SPY, and SPY is just S&P 500, and the stocks is green here, and the beige one is S&P 500. You can see that they are kind of on par. Okay, sometimes stocks swings quite a lot. I think this is when we had problems with the euro crisis, with Greece and everything. And then we have here higher peaks for S&P 500, but they go quite hand in hand. So right now the volatility is looking higher for S&P 500, whereas stocks has lower one. But that doesn't, if you look at the trend overall, they look quite even in that sense. However, where it really changes is if we look at something called Sharpe's ratio. And Sharpe's ratio just basically helps you understand how much are you getting compensated for the extra risk you're taking by investing in ETF instead of something risk-free like putting it on your bank account. The higher number, the better. And it just means you're getting more money for your, for the risk you're taking. And if we compare these, you see that S&P 500 is just beating it almost consistently. And right now they're quite even. Actually, might be even that it's turned around. So here, stocks is slightly ahead, but you can see that historically, or at least for the last 10 years, S&P 500 has been, you get more money for the risk you're taking with S&P 500. Now, the other cons of going EU only is, for example, you don't have all the sectors. Like the tech sector is very weak in Europe when we compare it to the US. And also you just have lower trading volumes, so slightly lower liquidity. So it's a bit harder to sell your stock. In practice, it's not, but there's a big difference between the fund sizes. So, it's just easier in the US. But honestly, the other cons, I could live with those if the performance was close to the US, if it was just a little bit off. But we have a big difference. So rationally speaking, performance and risk management should be your top priority as an investor. The performance has been much better in the US, and you would think there's some nice advantages in EU, but honestly, it seems to be more risky to invest in. So let me give you my unfiltered opinion on this whole situation because it is quite complex. So first of all, when this whole tariff thing happened or started with the 10% and now we are talking about 50% on EU goods, I do feel like in the beginning especially I was a little bit offended by this. I thought the US is our allies, they're our friends, and it's weird to put us like this as rivals now because for so long we worked only together. It's sort of a West against everybody else, right? That said, I do understand that we have been, in Europe, we've been just riding with the US or kind of just using them to protect ourselves, especially for when we talk about that. So I understand why they might not want to do that forever. And maybe it's a good wake-up call for us that we actually need to stand a little bit or be a bit more autonomous in this kind of sense, especially defense and maybe some strategic resources. But yeah, the first reaction was a bit offended. I think the way they handled it was way too shocking. And yeah, it just doesn't look like good because I feel like a lot of people now have bad thoughts about Americans, whereas I think that's not how it should be. There are great people out there, but their government is something you're not agreeing with. It's a wake-up call for the EU. It's also nice to see that EU is actually making some actions on this. So, for example, now US is cutting some funds for research, for science. EU has a big budget just for that, to attract that talent to Europe, so that later on we have some innovations that the way that US has grown. We want to have that kind of a just new type of a Silicon Valley, maybe in a different industry, but something that can drive European companies, industries that can just drive more revenue and create jobs here in Europe. So that's kind of the macroeconomics, or my opinion on that. But if we talk about investing, in that case, I do think it's a bit naive to just move your money to European companies. I feel like the companies have to become more attractive first, and then we can follow, because there's no reason for you to move your money to a company that might die because they're not competitive. It's just because they're in Europe, it doesn't make sense as an investor. I feel like we need to first build up that new sector or maybe tech sector to make it a bit more competitive compared to US and now China. We need to do that first, and then investors will follow with their money. And not only European investors, but I'm sure US investors and Asian investors will also follow. But we need to create those opportunities. By just adding money now there, it might not help anybody actually. So in my opinion, instead of just investing in EU companies, I'm thinking about more like maybe I can support companies that are doing well here, so by buying them. So actually taking a bit of time to research if there's European alternatives, and they need to be good enough or like on par with the other competition. But basically that way you actually directly support the company. And there's an interesting video from Tech Altar where I think for 30 days he only uses a European made tech. And it's really interesting to see that we actually have everything we need. They're just not very popular products, so that's why we don't hear about them so much. But I'll link that video in the description if you're interested. Super interesting to see that we have alternatives. We just never hear about them because US is dominating the tech sector. So personally, when it comes to investing, the maximum I might do is start investing a bit more into world ETF. Right now, I'm just buying S&P 500 ETF, but I might change that. I have to see how this goes. But remember, world ETFs, most of them have 60 or 70% exposure to US anyway. So it's not really moving away from US, it's just maybe reducing that how much your portfolio is depending on them. Because the way I'm thinking about it, is US really doomed? Or is it just, kind of media and social media just making it seem like things are worse than they are? And I'm curious how things turn out. I don't have any type of a crystal ball. I hope we are gonna go back to a bit more normal, at least in 3.5 years when the US government changes again, but maybe these changes are here to stay. So we do need to prepare for it. But now as an investor, I just don't see why you should go EU only just because you're European. There's other ways to support European companies, and I think you can start that way first and then think about investing if those companies are actually attractive investment opportunities. Now, I'm not saying that you shouldn't invest in EU or specific stocks in EU, because there are very interesting ones. But what I'm trying to say is maybe don't base your judgment just because you want to be more patriotic and buy European companies. Maybe that's short-sighted and it's gonna hurt you more than anybody else. But what do you think? I feel like this is a very complex issue, and a lot of emotions will come out just because, hey, now we have this situation where, oh wait, they are our enemies and they're not with us, and it becomes a little bit more competitive that way. What do you think about this? Just let me know in the comments. I check all of them. Now, I've been investing for the last 8 years or so, and there are a few mistakes that I really wish I hadn't made. Without them, my portfolio would have been probably double the size. That's why I created this video right here, so you can avoid losing time and money by making the same mistakes I did.